Question 1. What is the primary purpose of underwriting in insurance? A. To evaluate the risk of insuring a person or property. B. To determine the premium payment schedule. C. To assess the value of the insurance policy. D. To calculate the claims payout limit. Question 2 scenario. Mr. Harris is seeking a homeowner's insurance policy in Massachusetts. He has a history of a few small claims, including a water damage incident in his basement and a fire caused by a faulty appliance. The insurance company requires additional documentation to process his application. What step is the insurance company most likely taking? A. They are assessing Mr. Harris' risk level based on past claims. B. They are reviewing the general terms and conditions of the homeowner's policy. C. They are conducting a background check on Mr. Harris' financial history. D. They are verifying Mr. Harris' eligibility for premium discounts. Answer A. They are assessing Mr. Harris' risk level based on past claims. Explanation. In this scenario, the insurance company is most likely reviewing Mr. Harris' past claims to assess his risk level. Insurance companies consider past claims history when underwriting policy, as individuals with frequent claims are generally seen as high risk. This information helps them determine whether they will offer coverage, at what premium and under what conditions. Options B, C, and D are not directly relevant to the specific underwriting process described in the scenario, which focuses on evaluating risk based on prior claims. Answer A. They are assessing Mr. Harris' risk level based on past claims. Explanation. In this scenario, the insurance company is most likely reviewing Mr. Harris' past claims to assess his risk level. Insurance companies consider past claims history when underwriting policy, as individuals with frequent claims are generally seen as high risk. This information helps them determine whether they will offer coverage, at what premium and under what conditions. Options B, C, and D are not directly relevant to the specific underwriting process described in the scenario, which focuses on evaluating risk based on prior claims. Question 3. Which of the following types of insurance policies typically includes coverage for damage caused by earthquakes? A. Homeowners insurance. B. Flood insurance. C. Earthquake insurance. D. Renters insurance. Answer C. Earthquake insurance. Explanation. Earthquake insurance is a specific type of coverage designed to protect against damages caused by earthquakes, which are typically excluded under standard homeowners and renters insurance policies. In contrast, flood insurance provides coverage for water damage resulting from flooding, while homeowners and renters insurance policies often do not cover earthquake damage. Earthquake insurance is necessary for individuals in areas prone to seismic activity, and it is a separate policy that can be added as a rider or purchased independently. Question 4. Which of the following is an example of a fiduciary responsibility of an insurance producer? A. Paying the premiums directly to the insurer. B. Retaining a portion of the premiums as personal income. C. Using client funds for personal expenses. D. Disclosing commissions earned from policies to clients. Answer D. Disclosing commissions earned from policies to clients. Explanation. A fiduciary responsibility in the insurance industry means that the producer must act in the best interest of the client. This includes disclosing any commissions or compensation received from insurance policies, as transparency is essential to avoid conflicts of interest and ensure ethical behavior. Option A is incorrect because the producer should not pay premiums directly unless acting as a direct representative. Option B is incorrect because it represents a breach of fiduciary duty, as using client funds for personal purposes is illegal. Option C is similarly a violation of fiduciary duty. Question 5. Which of the following terms refers to the amount the policyholder must pay out of pocket before an insurer begins to cover claims in a health insurance policy? A. Copayment. B. Coinsurance. C. Premium. D. Deductible. Answer D. Deductible. Explanation. A deductible is the amount a policyholder must pay out of pocket before their insurance coverage begins to pay for covered expenses. For example, if a health insurance policy has a $1,000 deductible, the insured would need to pay the first $1,000 of their medical expenses before the insurer pays for any claims. Copayments and coinsurance are additional forms of cost sharing, but they come into play after the deductible has been met. Premium is the regular amount paid to maintain the insurance policy. Question 6. Scenario MS. Thompson applies for a long-term care insurance policy in Massachusetts. She is 62 years old and has a history of mild cognitive impairment. Her insurer asks her to undergo a medical exam and submit medical records before proceeding with the application. What is the insurance company primarily trying to assess? A. The financial stability of MS. Thompson. B. The risk associated with insuring MS. Thompson. C. The amount of coverage MS. Thompson will need DMS. Thompson's eligibility for tax benefits. Answer. B. The risk associated with insuring MS. Thompson. Explanation. The insurer is conducting a medical exam and requesting medical records to assess the risk of insuring MS. Thompson, particularly because of her history of cognitive impairment, insurers use this information to determine whether MS. Thompson's condition increases the likelihood that she will need long-term care services, which could result in higher claims. The risk assessment process is central to underwriting, helping the insurer decide whether to approve or deny the application and at what premium. Options A, C, and D are unrelated to the primary purpose of underwriting, which is assessing risk. Question 7. Which of the following best describes the purpose of an endorsement in an insurance policy? A. To change the policy's coverage terms. B. To extend the duration of the policy. C. To reduce the policy's premium. D. To add an additional policyholder. Answer 8. To change the policy's coverage terms. Explanation. An endorsement is change or addition made to an existing insurance policy. It can alter the policy's coverage terms or exclusions, providing greater flexibility to customize policy based on the policyholder's needs. For example, an endorsement may be added to cover a new piece of property or add specific coverage for certain types of risk. While endorsements can sometimes affect the policy's premium, their primary purpose is to modify coverage. Options B, C, and D are not accurate descriptions of what an endorsement does. Question 8. What is the main reason why insurance companies engage in reinsurance? A. To reduce the risk of claims that exceed a certain amount. B. To manage regulatory compliance. C. To increase policyholder benefits. D. To avoid paying taxes on premiums. Answer A. To reduce the risk of claims that exceed a certain amount. Explanation. Reinsurance is the practice of an insurance company transferring a portion of its risk to another insurer, the reinsurer, in order to reduce the likelihood of large claims that exceed the insurer's capacity. By engaging in reinsurance, the primary insurer can protect itself from catastrophic losses, ensuring stability and reducing the financial burden of high-volume claims. Reinsurance does not directly affect policyholder benefits or tax obligations, making options B, C, and D incorrect. Question 9. Which of the following is a key characteristic of a named peril insurance policy? A. It covers all risks except those specifically excluded. B. It only covers losses caused by perils specifically listed in the policy. C. It provides coverage for acts of war and terrorism. D. It automatically includes flood and earthquake coverage. Answer B. It only covers losses caused by perils specifically listed in the policy. Explanation. A named peril policy only covers those perils explicitly named in the policy. Common named perils might include fire, theft, and vandalism, but if the peril is not specifically listed, it is not covered under this type of policy. In contrast, an all-risk policy covers all perils except those specifically excluded. Option A describes an all-risk policy, not a named peril policy. Options C and D are related to the concept of named perils, as specific exclusions or additional coverage must be obtained separately. Question 10. In Massachusetts, which of the following is required for an insurance producer to maintain their license? A. Completing 15 hours of continuing education every 2 years. B. Passing a re-examination every 5 years. C. Paying an annual licensing fee. D. Providing insurance to a minimum of 20 clients annually. Answer A. Completing 15 hours of continuing education every 2 years. Explanation. In Massachusetts, insurance producers must complete 15 hours of continuing education, C, every 2 years to maintain their license. This requirement ensures that producers stay up to date on industry developments and regulatory changes. While paying an annual licensing fee is required, it is not the main condition for maintaining the license. A re-examination or providing insurance to a specific number of clients is not a requirement for license renewal. Question 11. Which of the following is true regarding the role of an insurance producer in the underwriting process? A. The producer has the authority to approve or deny an application. B. The producer is responsible for providing policyholder claims information to the insurer. C. The producer provides information to the insurer to assist in the underwriting decision. D. The producer is required to perform a medical exam on all applicants. Answer: C. The producer provides information to the insurer to assist in the underwriting decision. Explanation: the insurance producer plays a key role in the underwriting process by gathering information from the applicant, e.g., medical records, financial information, and submitting it to the insurer to assist in the underwriting decision. However, the producer does not have the authority to approve or deny an application, which is the responsibility of the insurer's underwriters. The producer is also not responsible for performing medical exams unless specifically acting as a medical examiner. Option B is incorrect because the producer's role is to provide accurate information at the time of application, not specifically claims data. Question 12. In Massachusetts, which of the following is a violation of an insurance producer's fiduciary responsibility? A. Paying premiums collected from clients to the insurer within the required time frame. B. Keeping client funds in separate trust account for safekeeping. C. Using client premiums for personal business expenses. D. Disclosing all forms of compensation to clients. Answer: C. Using client premiums for personal business expenses. Explanation: insurance producers are fiduciaries, meaning they have a legal and ethical duty to act in the best interests of their clients. Using client premiums for personal business expenses is a clear violation of fiduciary duty and is illegal. Fiduciary duties also require that premiums be kept in a trust account separate from personal or business funds and that the producer discloses all forms of compensation to the client. Options A, B, and D are all examples of proper fiduciary behavior. Question 13. Which of the following best describes the incontestability clause in a life insurance policy? A. The insurer can cancel the policy if the insured's health condition worsens. B. The insurer cannot contest the policy after a certain period, usually 2 years. C. The policyholder cannot contest the insurer's decision to deny claim. D. The policy becomes valid only if the insured pays premiums for 5 consecutive years. Answer: B. The insurer cannot contest the policy after a certain period, usually 2 years. Explanation: the incontestability clause in a life insurance policy prevents the insurer from voiding or cancelling the policy after a specified period, typically 2 years, except for cases of fraud. After this period, the insurer can no longer contest the policy even if there were misstatements made by the insured during the application process. Option A is incorrect because the contestability clause pertains to the insurer's actions, not the insured's health condition. Option C is incorrect because the clause pertains to the insurer's ability to contest the policy, not the policyholder's actions. Option D refers to premium payment terms, not the incontestability clause. Question 14. Scenario: Mr. Adams, a 35-year-old business owner, applies for a disability income insurance policy. He discloses a prior history of knee surgery, but states he is in good health and does not anticipate future complications. The insurer decides to exclude coverage for knee-related disabilities in the policy. Which of the following is the most likely reason for this exclusion? A. The insurer believes that knee problems are too minor to insure. B. The exclusion is due to Mr. Adams' age. C. The insurer is responding to a pre-existing condition disclosed by Mr. Adams. D. The insurer does not offer coverage for any musculoskeletal conditions. Answer: C. The insurer is responding to a pre-existing condition disclosed by Mr. Adams. Explanation: insurance companies often exclude coverage for pre-existing conditions, which are health issues the applicant had before applying for insurance. In this case, the insurer has excluded coverage for knee-related disabilities due to Mr. Adams' history of knee surgery. This is a standard practice to protect the insurer from high-risk claims. The exclusion is not due to Mr. Adams' age. Option B, nor is it a blanket policy for musculoskeletal conditions. Option D, as the insurer could still cover other musculoskeletal issues. Option A is also incorrect because knee problems, depending on the severity, could still be insurable. Question 15. Which of the following types of health insurance is typically characterized by lower premiums and limited choice of healthcare providers? A. Health Maintenance Organization, HMO. B. Preferred Provider Organization, PPO. C. Exclusive Provider Organization, EPO. D. Point of Service, POS. Answer: A. Health Maintenance Organization, HMO. Explanation: health maintenance organizations HMOs generally offer lower premiums compared to other types of health insurance. However, they also come with limitations on healthcare providers, as policyholders must use a network of providers. HMOs require members to select a primary care physician and obtain referrals for specialist care. PPOS, EPOS, and POS plans offer more flexibility in choosing healthcare providers, but typically come with higher premiums. Option B, C, and D all involve some level of flexibility, but generally at a higher cost. Question 16. Which of the following best defines underwriting in the insurance industry? A. The process of determining the appropriate premium for a policyholder. B. The process of issuing the policy to the insured. C. The process of determining whether to accept or reject an application based on risk factors. D. The process of paying out claims to policyholders. Answer: C. The process of determining whether to accept or reject an application based on risk factors. Explanation: underwriting is the process by which an insurance company evaluates the risk of insuring an applicant. This process involves reviewing the applicant's medical, financial, and other relevant information to determine whether the insurer will accept or reject the application and at what premium. Option A is incorrect because premium determination is a part of the underwriting process but not the entire definition. Option B refers to policy issuance, which occurs after underwriting. Option D refers to the claims process, which occurs after the policy is in force. Question 17. Which of the following is a characteristic of a variable life insurance policy? A. The death benefit and cash value are both fixed. B. The policyholder can invest the cash value in a variety of securities. C. The policyholder is guaranteed a fixed premium rate. D. The policy has no cash value accumulation. Answer: B. The policyholder can invest the cash value in a variety of securities. Explanation: variable life insurance policies allow policyholders to invest the policy's cash value in a variety of securities such as stocks, bonds, and mutual funds. This type of policy offers the potential for growth but also comes with investment risk. The death benefit and cash value are not fixed as they depend on the performance of the underlying investments. Option A is incorrect because both the death benefit and cash value can vary. Option C is incorrect because premium rates in a variable life policy can fluctuate depending on the performance of the investments. Option D is incorrect because a variable life policy does accumulate cash value, though it may vary based on investment outcomes. Question 18. Which of the following is not a purpose of insurance contracts? A. To transfer risk from the insured to the insurer. B. To provide a source of funding for the insurer's operational costs. C. To create legally binding obligations for the parties involved. D. To establish terms under which an insurer can deny claims. Answer: D. To establish terms under which an insurer can deny claims. Explanation: insurance contracts are designed to transfer risk from the insured to the insurer, provide a legal framework for both parties, and clarify the terms of coverage, premiums, and obligations. They do not serve as a mechanism for the insurer to arbitrarily deny claims. In fact, they should outline the circumstances under which claims can be denied based on exclusions, limitations, or conditions specified in the policy. Option B is correct because insurance premiums help cover the insurer's operational costs, but they are not the primary purpose of the contract. Question 19. Which of the following is true about a raw risk property insurance policy? A. It only covers the perils explicitly listed in the policy. B. It covers all perils unless specifically excluded. C. It provides coverage for named perils with higher limits. D. It requires additional premiums for certain types of coverage. Answer: B. It covers all perils unless specifically excluded. Explanation: a more risk policy covers all perils except for those that are explicitly excluded in the policy. This is broader coverage than a named peril policy, which only covers risks listed in the policy. Option A is incorrect because it describes a named peril policy, not an all-risk policy. Option C is incorrect because all-risk policies do not focus on named perils. Option D is not necessarily true, as the price of an all-risk policy may vary based on coverage limits, but exclusions or additions are what typically affect premiums. Answer: C. To promptly remit premiums to the insurer or keep them in a trust account. Explanation: in Massachusetts, insurance producers are required to hold client premiums in a trust account or remit them directly to the insurer in a timely manner. Producers must not mix personal funds with client funds or use them for personal purposes. Handling client funds in this manner is a legal requirement to ensure transparency and proper management of funds. Option A is incorrect because the producer does not collect commissions on behalf of the client but for their own compensation. Option B is incorrect as it is illegal to deposit client premiums into a personal bank account. Option D is incorrect because investing client premiums for growth is not allowed under the fiduciary responsibilities of an insurance producer. Question 20. In Massachusetts, what is the primary duty of an insurance producer when it comes to handling client funds? A. To collect commissions from the insurer on behalf of the client. B. To deposit client premiums in a personal bank account. C. To promptly remit premiums to the insurer or keep them in a trust account. D. To invest client premiums in low-risk securities for future growth. Question 21. Which of the following is a feature of a term life insurance policy? A. It builds cash value over time. B. It provides coverage for a specified term with no coverage beyond that period. C. It can be converted to a permanent policy without proof of insurability. D. It guarantees that the premiums will stay the same for the life of the policy. Answer: B. It provides coverage for a specified term with no coverage beyond that period. Explanation: a term life insurance policy provides coverage for a specific period, e.g. 10, 20, or 30 years, and once the term ends there is no coverage unless renewed or converted. It does not accumulate cash value, which distinguishes it from permanent life insurance policies, whilst term policies offer a conversion option. Option C. Term life itself does not build cash value, and premiums may increase upon renewal. Option D refers to permanent policies like whole life insurance, not term life. Question 22. Which of the following is an example of moral hazard in insurance? A. A policyholder not reporting a claim to the insurer. B. A policyholder intentionally damages their own property to collect insurance benefits. C. A policyholder underreporting the value of their property when applying for coverage. D. A policyholder having a higher than expected medical cost due to an accident. Answer: B. A policyholder intentionally damages their own property to collect insurance benefits. Explanation: moral hazard refers to situations where a policyholder takes actions that increase the likelihood of a loss or intentionally causes a loss to benefit from an insurance payout. In this case, intentionally damaging property for insurance benefits is an example of moral hazard. Option A describes a failure to report a claim, which may be considered fraud but is not specifically moral hazard. Option C refers to adverse selection where an applicant misrepresents the value of property, and Option D relates to an unforeseen event that is not caused by any unethical behavior. Question 23. Scenario: a policyholder has a homeowner's insurance policy with a $1,000 deductible. After a storm, their home incurs $3,500 worth of damage. How much will the insurance company pay for the claim? A. $3,500. B. $2,500. C. $1,000. D. $0. Answer: B. $2,500. Explanation: in this scenario, the policyholder's deductible is $1,000, meaning they will need to pay the first $1,000 of the damage themselves. The insurance company will then pay the remaining amount, which is $2,500, $3,500 total damage, $1,000 deductible. Option A is incorrect because the policyholder must cover the deductible amount. Option C is incorrect because the deductible amount is subtracted from the claim, not paid out. Option D is incorrect because the insurance company is responsible for the remaining $2,500 after the deductible is applied. Question 24. Which of the following is a type of insurance that covers the loss of income due to disability? A. Disability income insurance. B. Homeowners insurance. C. Property insurance. D. Term life insurance. Answer: A. Disability income insurance. Explanation: disability income insurance provides a source of income for individuals who are unable to work due to illness or injury. This type of insurance typically replaces a percentage of the policyholder's lost wages. Homeowners insurance. Option B covers property damage. Property insurance. Option C is broader category that includes coverage for assets and term life insurance. Option D provides death benefit, not income for disability. Question 25. Which of the following is a typical exclusion found in a standard homeowners insurance policy? A. Damage caused by fire. B. Damage caused by earthquakes. C. Loss of personal property due to theft. D. Damage caused by vandalism. Answer: B. Damage caused by earthquakes. Explanation: earthquake damage is typically excluded from standard homeowners insurance policies. Homeowners can purchase separate earthquake coverage if desired. Fire damage, option A, theft, option C, and vandalism, option D, are usually covered by standard homeowners policies, though there may be limits or specific conditions that apply. Question 26. In the context of property insurance, what does the term replacement cost refer to? A. The amount paid by the insurer to repair or replace damaged property with like kind and quality. B. The current market value of the property before any damages. C. The amount the insured must pay out of pocket before the insurance coverage applies. D. The cost of purchasing new property with better features than the original. Answer A. The amount paid by the insurer to repair or replace damaged property with like kind and quality. Explanation: replacement cost in property insurance refers to the amount paid by the insurer to repair or replace damaged property without accounting for depreciation. This coverage ensures that the insured can replace the damaged property with one of similar kind and quality. Option B refers to market value, which accounts for depreciation and may be different from replacement cost. Option C refers to a deductible, and option D would describe an upgrade scenario, not the definition of replacement cost. Question 27. Which of the following is a key characteristic of an insurance policy that uses coinsurance? A. The insurer pays the full amount for any loss. B. The policyholder shares in the cost of covered losses. C. The policyholder receives full reimbursement up to a certain amount. D. The policyholder receives a fixed cash benefit for a covered loss. Answer: B. The policyholder shares in the cost of covered losses. Explanation: coinsurance is a provision in many insurance policies that requires the policyholder to share part of the cost of a claim, typically expressed as a percentage of the total claim amount. For example, in a health insurance policy with a 20% coinsurance, the insured would pay 20% of the covered medical expenses and the insurer would pay the remaining 80%. Option A is incorrect because coinsurance involves sharing the cost. Option C describes coverage limits, not coinsurance. Option D refers to fixed benefit policies, not coinsurance. Question 20. Which of the following is true about a premium audit in the context of a commercial insurance policy? A. The insurer conducts the audit to determine the appropriate premium for future periods. B. The insured is required to submit a form or application to request an audit. C. The audit is performed annually to adjust the premium based on actual exposure. D. The premium audit only applies to life insurance policies. Answer: C. The audit is performed annually to adjust the premium based on actual exposure. Explanation: a premium audit in commercial insurance is typically conducted annually to determine the actual exposure, such as peril or sales, for the insured. The insurer will use this information to adjust premiums to reflect the true level of risk. Option A is incorrect because the audit adjusts past premiums, not future premiums. Option B is incorrect because the insurer typically conducts the audit. Option D is incorrect because premium audits apply to many types of commercial insurance, not just life insurance. Question 29. What is the primary purpose of subrogation in insurance? A. To provide coverage for an additional insured party. B. To allow the insurer to recover costs from a third party responsible for a loss. C. To allow the insured to recover policy premiums from the insurer. D. To guarantee payment of claims regardless of faults. Answer: B. To allow the insurer to recover costs from a third party responsible for a loss. Explanation: subrogation is the process by which an insurer seeks reimbursement from a third party who is responsible for a loss. If an insurer pays a claim to an insured party, they may attempt to recover the payment from the party responsible for the damage. Option A refers to additional insured parties, but does not explain subrogation. Option C is incorrect because subrogation does not involve premium recovery. Option D is incorrect because subrogation applies to third parties responsible for the loss, not guaranteeing payment without regard to fault. Question 30. Which of the following is an example of property damage coverage under an auto insurance policy? A. Medical expenses for injuries sustained in a car accident. B. Repairs to the insured vehicle after a collision. C. Damage to another person's vehicle in an accident. D. Lost wages due to an inability to work after an accident. Answer: C. Damage to another person's vehicle in an accident. Explanation: Property damage coverage under an auto insurance policy covers damage to another person's property, typically their vehicle, in the event of an accident where the insured is at fault. This coverage helps pay for the cost of repairs or replacement of the other party's property. Option A refers to bodily injury coverage, which pays for medical expenses. Option B refers to collision coverage, which pays for the repairs to the insured's own vehicle. Option D refers to lost wages, which may be covered by disability or personal injury policy, not property damage coverage.